Okay, you want to own a KFC franchise. From the parking lot, it looks almost ridiculously simple. People walk in hungry, order chicken, fries, biscuits, and a drink, and a few minutes later, they walk out, carrying a box with the Colonel's face on it. The customer sees dinner. The owner sees a cash register. But underneath that bucket of chicken is a business with millions of dollars tied up in real estate, equipment, labor, food, advertising, franchise fees, and one very important question. After everybody else gets paid, how much is actually left for you? That question matters because buying a KFC is not like buying a small restaurant. You are buying access to one of the most recognizable restaurant brands in the world. But you are also accepting a system where the brand controls a huge part of how your business operates. KFC is owned by Yum Brands, the same parent company behind Taco Bell, Pizza Hut, and Habit Burger & Grill. And Yum says more than 97% of its restaurants worldwide are operated by independent franchisees or licensees. That sounds attractive. You are not inventing a restaurant concept from scratch. You do not have to convince America that fried chicken exists. You do not have to explain what KFC is. Millions of customers already know exactly what they're going to get before they even open the menu. And that recognition is precisely what makes the economics interesting. Because the most expensive thing you can build in a restaurant business is not a kitchen. It is trust. A new restaurant has to spend money convincing customers to try it. KFC gets a start with decades of brand recognition already sitting above the door. But that advantage doesn't come free. The first surprise is how much money you need just to get into the game. Recent public summaries of KFC's 2026 U.S. franchise disclosure document put the estimated initial investment for a traditional restaurant at roughly $2.11 million to $4.16 million, including a $45,000 initial franchise fee. That range is enormous because a restaurant in an existing building is a completely different financial project from building a new freestanding location from the ground up. Real estate can change the entire equation. Construction can change it again. And equipment can turn what looked like $1 million project into a multi-million-dollar commitment before you've sold your first piece of chicken. So imagine you have the money. You find a location, the site gets approved, the paperwork is signed, the building goes up, the kitchen is installed, and finally, after months of spending money without collecting a dollar, the doors open. Now, the real business begins. And this is where people make their first major mistake. They look at the price of a meal. Suppose a restaurant sells a $12 order. It's very tempting to think the chicken might cost $3 or $4, leaving a giant pile of money behind. But that $12 does not belong to you, not even close. Before you think about profit, the restaurant has to pay for the chicken, then the cooking oil, then the breading, then the packaging, then the fries, then the drink, then the employees, then payroll taxes, then rent, then electricity, then insurance, then repairs, then cleaning, then technology, then advertising, then the franchisor. And suddenly, the $12 meal that looked incredibly profitable from the customer side starts looking much more ordinary from the owner side. This is the first rule of restaurant economics. Revenue is not income, and sales are not profit. KFC's current franchise economics make that distinction especially important because public FDD data shows an ongoing royalty of 4% of gross sales, alongside a marketing or brand fund contribution of about 5.8%, plus a monthly technology fee. That means a restaurant doing $1 million in annual sales would be sending roughly $40,000 in royalty payments and another $58,000 toward the marketing fund before you even start talking about rent, wages, food, debt, or taxes. The restaurant can be busy. The restaurant can have a line at lunch. The restaurant can sell thousands of meals every month, and those percentage-based fees still collect their share. That's an important difference between owning a franchise and owning an independent restaurant. With an independent restaurant, you have almost complete control over the economics. With a franchise, you're buying a system, and the system gets paid whether your week was amazing or terrible. That sounds painful until you look at what the system is actually giving you. A KFC franchisee is not building a brand from zero. The customer already recognizes the logo. The menu has already been developed. The recipes and operating standards already exist. The supply chain is already established. The advertising machine already exists. The training system already exists. And the franchisor has spent decades figuring out how to make thousands of restaurants operate in a reasonably consistent way. That consistency is worth something. Imagine opening your own chicken restaurant tomorrow. You would have to decide what the menu looks like. You would have to test recipes. You would have to negotiate with suppliers. You would have to build a recognizable identity. You would have to figure out packaging. You would have to learn how much chicken to order on Tuesday compared to Saturday. You would have to figure out what happens when demand suddenly doubles because of a promotion. And you would have to convince people that your chicken is worth trying instead of driving another half mile to a brand they already know. KFC has already solved most of those problems. But solving them doesn't mean your store becomes passive. It means the job changes. You are no longer inventing the restaurant, you are operating the machine. And operating a fast food restaurant at scale is a lot harder than it looks from the dining room. Picture a normal Saturday. At 11:30 in the morning, the restaurant is calm. At 12:15, cars begin stacking up. At 12:40, the kitchen's suddenly producing orders at a completely different speed. Chicken has to be available, fries have to be available, the front counter has to move, the drive-thru has to move, delivery orders have to move. The kitchen cannot suddenly decide that today is a slow day. And if the manager scheduled too few people, the customer feels it immediately. The line gets longer, orders slow down, mistakes appear, customers get annoyed, and some of them simply leave. But scheduling too many employees creates the opposite problem. Now the restaurant is paying people to stand around during quiet periods. That's the cruel part of restaurant labor. You can't only pay employees when customers are standing in front of them. You have to pay people to be ready, and readiness costs money. The same thing happens with the kitchen. A fryer is not valuable because it looks impressive. It's valuable because it lets the restaurant turn raw ingredients into sellable food quickly enough to handle a rush. But equipment also creates another problem. Everything eventually breaks. A fryer can fail. A refrigeration system can fail. A freezer can fail. A point-of-sale terminal can fail. A drive-thru system can fail. And restaurants are especially unforgiving when equipment goes down during peak hours. If a machine breaks at 2 in the afternoon on a Tuesday, you have a problem. If it breaks at 7 on Friday night, you have a financial event.
That is because the restaurant's most profitable periods are often concentrated into relatively short windows. A restaurant can lose a meaningful amount of sales in a few hours, and those customers do not necessarily come back later to make up for it. This is where the value of the KFC brand becomes more complicated. The brand brings customers, but the brand also creates expectations. If someone drives into a KFC, they expect KFC. They expect the food to taste familiar. They expect the experience to be recognizable. They expect the restaurant to look like the restaurant they visited in another city. That consistency is one of the reasons franchise systems work. But consistency requires rules, and rules reduce your freedom. You cannot simply wake up one morning and decide your KFC should have a completely different menu. You cannot change the cooking process because you think your method is better. You cannot redesign the brand because you are bored with the current one. You are operating inside somebody else's playbook. For some entrepreneurs, that is restrictive. For others, it is exactly what they are paying for. The interesting question is whether the playbook makes enough money to justify the price. Recent public FDD summaries indicate that KFC's 2025 reported average unit revenue was around $1.3 million, with a median around the same level across a large sample of restaurants. That number sounds impressive until you put it beside the investment required. If you spend $2 million or more to create a business that generates roughly $1.3 million in annual sales, the sales number alone tells you almost nothing about your return. You need to know what happens after the $1.3 million arrives. And this is where the KFC business becomes a game of percentages. Let's create a hypothetical restaurant doing $1.3 million in annual sales. The exact numbers will vary dramatically by location, rent, wages, debt, sales mix, operating efficiency, and the age of the building. So think of this as a model rather than a promise. Start with the franchisor-related fees at roughly 9.8% for royalty plus marketing. That is about $127,000 on $1.3 million of sales before the monthly technology fee. Now imagine food and packaging consuming roughly 1/3 of sales. That's another $430,000 or so. You're already around $557,000 gone. Then comes labor. Depending on the market and staffing model, labor can become one of the largest expenses in the entire restaurant. Use a hypothetical 30% for wages and related payroll costs. That's another $390,000. Now you're around $947,000, and you haven't paid rent, you haven't paid insurance, you haven't paid utilities, you haven't paid repairs, you haven't paid property taxes if you own the building, you haven't paid loan interest, you haven't paid taxes on profit, and you haven't paid yourself. itself. This is why a restaurant can produce 7 figures in sales and still leave its owner with a surprisingly modest return. The customer sees volume. The owner sees leakage. Money leaves through dozens of small doors, and the biggest challenge is that most of those doors are not optional. You cannot stop buying chicken because margins are tight. You cannot stop paying employees because sales are weak. You cannot stop paying rent because Tuesday was slow. You cannot stop paying franchise fees because the weather was terrible. The expenses keep moving even when customers do not. That is why location matters so much. A KFC next to a busy shopping center has a completely different economic engine from a KFC hidden behind the poorly designed parking lot. The food may be identical, the brand may be identical, the employees may be equally good, but customers are not equally convenient. And convenience is one of the most powerful forces in fast food. People are not usually driving around town asking themselves where they can find the world's greatest fried chicken. They're thinking about what they can eat without wasting 20 minutes. That means traffic patterns matter, visibility matters, access matters, parking matters, drive-through design matters, nearby businesses matter, residential growth matters, and competition matters. A great KFC location can make an average operator look brilliant. A terrible location can make a very competent operator look incompetent. This is why experienced franchise investors obsess over real estate. They know something that first-time entrepreneurs often learn too late. The restaurant is not the only business. The real estate is part of the business. And if you sign a lease that is too expensive, you can spend 10 years trying to fix a mistake you made in one afternoon. This becomes even more important because the franchise investment can be enormous. The latest public 2026 FDD data puts the estimated traditional KFC investment range at approximately $2.1 million to $4.2 million. At the high end, you're no longer talking about a side project, you're talking about serious capital. And most entrepreneurs aren't walking into a bank with $4 million in cash. They're financing some portion of the project, which means the restaurant doesn't just need to make a profit, it needs to make enough profit to service the debt. That changes the psychology completely. Imagine you borrowed $2 million to build your restaurant. Your restaurant has a good month. Sales are strong, the drive-thru is busy, customers are happy. Then you look at the bank account. A large part of the cash is already committed to loan payments. This is why debt can make a good restaurant feel poor. The business may be profitable on paper while the owner feels cash-starved in real life. And that brings us to the question most people actually care about. Can a KFC owner make serious money? Yes, but the answer is not hidden inside the price of a bucket. It's hidden inside scale. A single restaurant has limits. You can only sell so many meals from one kitchen. You can only fit so many cars into the drive-thru. You can only serve so many customers during lunch. But if you own 5 locations, something changes. Now your management structure can spread across multiple restaurants. Your purchasing relationships can become more meaningful. Your administrative costs can be shared. A strong manager can oversee a larger operation. And your personal wealth is no longer dependent on one parking lot. This is one reason sophisticated franchise operators think differently from first-time owners. The first-time owner asks, how much can this restaurant make? The experienced operator asks, how does this restaurant become the first piece of a network? That distinction matters. 1 restaurant can be a job, 5 restaurants can become a company, and 20 restaurants can become an asset. KFC's system is already built around large-scale franchising. Public FDD data indicates that the U.S. system has thousands of locations, and that the overwhelming majority are franchised rather than company-owned. Yum's broader model is similar. The company says its restaurant system spans over 63,000 restaurants across 155 countries and territories, with franchisees and licensees operating the vast majority. That tells you something important. The actual business model isn't Yum owning every restaurant. It's Yum creating a system that other people put capital into. That's the beauty of franchising. The franchisor can expand without paying the full cost of every new location. The franchisee gets a proven brand without having to build the entire concept. Both sides can win, but their incentives are not identical. The franchisor wants the brand to expand. The franchisee wants the individual restaurant to generate a strong return. Sometimes those goals line up perfectly. Sometimes they don't. A new corporate initiative may require remodeling. A new technology system may require
require investment. A new restaurant design may require construction spending. A franchisee might look at that expense and think, my restaurant is already working. The franchisor might look at it and think, the entire brand needs to keep moving forward. That's one of the hidden costs of owning a major franchise. You're buying a brand, but you're also agreeing to maintain the brand. And brands age. A restaurant that looked modern 10 years ago can look tired today. A kitchen can become outdated. Customer expectations can change. Drive-through technology can change. Delivery can change. Digital ordering can change. And suddenly, an owner who thought the initial investment was finished discovers that the business requires another round of capital. This is where the word passive should probably disappear from the conversation. Owning a KFC is not passive income. It's an operating business. The chicken doesn't cook itself. Employees need training. Managers need supervision. Inventory needs control. Food waste needs monitoring. Customer complaints need resolution. Maintenance needs attention. Labor needs scheduling. Cash needs reconciliation. And every day the restaurant is open, you're competing against every other restaurant within driving distance. The brand gives you a head start. It does not give you immunity. There's another interesting part of the economics. Chicken is a commodity. You cannot assume the price will stay fixed forever. Feed costs change. Corn changes. Soybean prices change. Transportation costs change. Labor costs change. Packaging costs change. And when costs rise, you face a decision. Raise prices and risk losing demand, or absorb the increase and watch your margin shrink. The customer doesn't care about your cost structure. They care that the meal still feels worth the price. That is one of the hardest parts of running any food business. You're constantly balancing affordability against profitability. KFC has an advantage here because it has enormous scale behind the brand. Yum operates a global restaurant system with substantial purchasing, technology, marketing, and franchise infrastructure. A small independent restaurant cannot negotiate from the same position, but the franchisee still carries the local risk. If the neighborhood changes, you feel it. If a major employer leaves town, you feel it. If a competitor opens nearby, you feel it. If the local labor market becomes expensive, you feel it. And if the economy slows down, customers may still buy fast food, but they may become more price sensitive. That is why a strong franchise owner is not simply a restaurant manager. They are part operator, part real estate analyst, part financial controller, part recruiter, and part risk manager. The restaurant is the machine. The owner's job is to keep the machine economically alive. Now imagine two KFC restaurants. They both generate $1.3 million in sales. One has cheap rent, strong traffic, low employee turnover, efficient management, and a clean, well-maintained building. The other has expensive rent, constant staffing problems, higher maintenance costs, and a weak location. From the street, they look almost identical. Inside the financial statements, they might as well be two different businesses. The first owner could be building real wealth. The second could be working 60 hours a week to create a business that barely pays for itself. This is the part that gets lost when people talk about franchise revenue. Revenue is a scoreboard. It is not the final score. The real number is the cash left after every obligation has been satisfied. And that is why the initial investment is only half the question. The other half is how quickly the restaurant can recover that investment. Suppose, purely as a simplified illustration, that you invest $2.5 million into a restaurant. If the business eventually produces $250,000 of annual cash flow before certain owner-level taxes and financing effects, the simple payback period is 10 years. If it produces $125,000, the same investment takes 20 years. Nothing about the sign outside changed. Nothing about the chicken changed. The difference is the economics underneath the sign. That is also why investors should be careful with averages. An average restaurant is not your restaurant. A national average cannot tell you what your local rent will be. It cannot tell you what your local wages will be. It cannot tell you whether your drive-thru will be packed on Friday night. It cannot tell you whether your equipment will need a major replacement. And it cannot tell you whether a competitor will open across the street next year. That is why the franchise disclosure document matters more than a glossy franchise brochure. It's where the investment estimates, fees, system information, and financial performance disclosures are documented. And the current public summaries make one thing very clear. KFC is not a low-cost franchise. The investment is measured in millions, not tens of thousands. So who should even consider it? Probably not someone who simply loves fried chicken. Probably not someone looking for passive income. And probably not someone who has barely enough capital to survive the opening. The better candidate is someone who understands operations, because the biggest danger is not necessarily that the restaurant fails immediately. The more dangerous scenario is that it survives while producing a disappointing being returned. You can spend years owning a business that technically works, while your money could have produced a better return somewhere else. That is the investor's real question. Not, does KFC make money? The question is, does this particular KFC make enough money for the capital and risk I am putting into it? And that changes the entire way you look at the business. The customer sees a bucket, the employee sees a shift, KFC sees a franchise location, the bank sees collateral and debt service, the franchisor sees another unit inside a global system. And the owner should see something different from all four. The owner should see a capital allocation decision. You are taking millions of dollars and turning them into a restaurant. You are betting that the location will attract enough customers. You are betting that labor will stay manageable. You are betting that food costs will not destroy your margins. You are betting that the brand will remain relevant. You are betting that the debt will remain serviceable. And you are betting that after all of that, the cash generated by the restaurant will justify what you paid to build it. That is the real economics of a KFC franchise. The chicken is only the product customers can see. The actual business is the invisible machine underneath it. Real estate, labor, supply chains, brand fees, debt, technology, traffic, management, and eventually scale. If you get those pieces right, a KFC can become much more than a restaurant. It can become the first unit in a portfolio of cash-flowing businesses. But if you get them wrong, the famous logo above the door cannot rescue the math. And maybe that's the most useful lesson in the entire story. A powerful brand can bring people through the door. It cannot decide what happens to the money after they leave. That part is still your job. And that is why the smartest franchise investors do not ask how many pieces of chicken they can sell. They ask how much of every dollar survives the journey from the customer's hand to the owner's pocket. Because in a business where millions of dollars can pass through the register every year, the fortune is not made by counting the sales. It's made by understanding what remains after the sales are gone. If you enjoyed this breakdown, subscribe for more deep dives into the economics hiding underneath the businesses we see every day.